Welcome everyone, Andy Tanner here. Full house tonight, of course. If you have any type of audio issue or anything like that, please be patient. Online meetings have become the standard, and the platform is rock and rolling, that's for sure. So, first order of business is if you can hear me, go ahead and raise your hand if you can hear me, and I'll take a look at that and see if I'm being heard. Welcome Alejandro and Anita and Anna. And we got a lot of Annas here tonight. Wonderful. And Alberto and Alejandro, and awesome. So fantastic. If I don't shout your name, forgive me. We have a lot of people attending tonight. So it's great that you can hear me. Welcome. Absolutely welcome. One of the things that we're going to do now is we're going to talk about trading, and the purpose of a Quick Start Lab is to excuse me, I've got a bit of a cough, so if I pause, it's because I'm muting myself so it doesn't get in your ear, and I don't guarantee that it won't get in your ear tonight. But part of the purpose of Quick Start Lab is exactly that, Quick Start. This course is a fast-track course. It goes quickly, and it's for people that say, look, Andy, show me, you and Corey, your 4 or 5, bread and butter cash flow trades, that really rock and roll. And so that's the plan. That's what we're going to do. Every single time we get together, I do a disclaimer, and I never gloss over it. Sorry, I was just going to have to cough. It's just what it is. I'm going to have to do a disclaimer here. And it's very important to understand what we do and what we don't do. I'm not a financial advisor. I don't tell people what to do. Even in the members of my own, community and circle of friends, I just caveat that, guys. Look, you do what you want. You're your own person. I do the same thing here. I'm here with Corey to give you what we call education. So it says for educational purposes only. There is no other purpose. And how many of you, by raise of hand, already watched the 42-minute video I do on this disclaimer about risk and attitude and all that? Put your hands up if you watched that, and I'll see if I can stretch this. Fantastic job, you guys. Great. So watch that. The second thing is today I had a very heartwarming letter from a new student, and I'll give the amount, not her name, but she's around my age. She just got laid off her job, and she wrote me a note that says, Andy, I had some money that was disposable income set aside. I lost my job in February, but I had some money set aside. And she says, I signed up like Sunday or whatever it is, and one day she made $7,000. And that warms my heart. I'd prefer she'd have done it on a paper trade account like I've asked, but she did say in the letter, hey, this was disposable income. I was okay in losing it. She goes, I know I might win, I might lose, and it warmed my heart to know we're doing some good. I actually got a little teary-eyed when I got that letter. But I've got to tell you, we never show those, because we don't give any warranties. If I say, oh, she made this, maybe other people think they're going to make this, and everyone is different. The third one and most important thing I can say, we have 4 pillars. If there was no risk involved, we'd only need 3 pillars. We have a whole pillar dedicated to the fact that this market is risky. We're going to look at an asset class tonight that's been all over the place, one of the most volatile, risky things that are out there. And the reason Corey and I can perform some of these trades is it's not the first time we've done it. And Corey, and I should welcome Corey. Sorry, Corey, I didn't give you the proper welcome, but welcome.
That's all right.
So, Corey, have you ever lost money trading before?
Yes, I have. Unfortunately, it's not all winners, and we have to manage risk, and we have to cash flow, and sometimes we have to make adjustments on the fly or delta hedge or some things that we'll kind of talk about as we go through these. But that's part of risk management and knowing what levers to pull in certain situations.
I usually take a lot of time to introduce myself, and Corey, we don't have the time for that tonight. I am a student of investing, and I'll always be a student investing. And some people say, hey, don't you teach investing? I go, well, I share what I'm learning as a student so far, because the moment I call myself a teacher, it makes people think that I know everything, and I don't. And I've been a 20-year student of this. Let's put it that way. Corey, you've been a 20-year student as well. Corey has better credentials than me. He was an options principal. We'll have time to learn what that is another day. But basically, Corey, you've managed a lot of risk on trading floors at firms. And, I've always asked you this. I say, how many traders did you manage? Hundreds of traders. I hate to even I'm not going to ask you, but I can't even imagine the type of money and leverage that in the aggregate that must have been. So interesting stuff. So I just say that to know that hopefully you're feeling in your good hands. Before I move off this, how many appreciate that I don't gloss over this? Because some people say, Andy, get to the goodies. We know you have to do this. You have a company. You got to protect yourself. How many appreciate it? I never gloss over it. Thanks, Eric. You had your hand up first. Thanks, Ian. Fantastic. I got 2 Ians right in a row. Very good, Ian. So great, fantastic. So the most important course that a person takes at the Cashflow Academy is the 4 Pillars course. Every single person is enrolled in that class because I don't allow people in this one unless they're enrolled in that one. So the 4 Pillars is a prerequisite to be in this meeting. If a person doesn't know the 4 Pillars, they shouldn't be in here. So this is you have to be enrolled in this to take this class. If somehow through some loophole of hackerness, maybe had a hacker get you in here and you're not in the 4 Pillars, get in the 4 Pillars. But everyone here should be already in, be moving along, and at least have a sense of what the 4 Pillars are. By raise a hand, how many at least understand what these 4 Pillars are? Yeah, you guys are beautiful. So what this is tonight is I've brought you into this program. We're teaching the 4 Pillars. Now we're going to try to apply these in a very fast way because we don't have much time to catch up. The people that enroll in the Quick Start Labs are trying to, this is a steep learning curve. We're not going to flatten the curve at all. It's still steep, but you're on a motorcycle and hopefully you can handle this curve. So with that, today we're going to talk about gold. And we're going to talk about why we're going to talk about gold. But right off the bat, I'm going to see how you guys do, and we're going to switch from raise of hand to type it in the chat box tonight. And I'm just going to see in the chat box, and in the not the chat box, the question box. The first pillar is fundamental analysis. So if you've been studying your 4 pillars, that I can look at your financial statement as a family. In about 5 minutes, I'll know where you are and whether I would loan you money. You follow that? If I were going to loan you money, that's an investment on my part. And if I look at your financial statement, I know in about 5 minutes whether I'd loan you money. The second one is I have a financial statement for, sorry for the pause, it's just a cough. It's not a problem with your sound. I'm just trying to mute when I can. Is for a corporate financial statement. It takes me a little longer than 5 minutes on this one, but in a pretty short amount of time, I can decide whether or not I'm interested in buying stock in that company or a corporate bond by looking at how their financial statement looks like, if it appeals to me. And then on the national level, I can take a country like Greece or a country like Portugal or Korea or Spain or wherever you want to go, Venezuela, the U.S., and very quickly, in about 5 minutes, I can tell how they compare to other countries. This corporate is the one that takes me the longest, but personal and sovereign is like, boom, it's way fast. And so let's just type in the tax. You can do A, B, C, all of the above, A and C, B and C, B and A, whatever you want. Type in either personal, corporate, or sovereign. When we're talking about gold, which fundamental analyses will we be conducting tonight to make decisions on whether to buy gold? On your marks, set, go. So we got sovereign, 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 sovereign. This beautiful sovereign, 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 sovereign. So almost, okay, I really love Simon Tracy. So Simon Tracy, I love. Kathy Reeser, I love. In fact, I love all of you because 99% of you said sovereign. And Anita and a few others said all 3. And some of you said Simon Tracy, A or C. Well, here's what's interesting. I say A and C. I would say personal and sovereign. Here's why. I don't know if this is a suitable investment for me unless I look at my own fundamental analysis and see what my goals are and what I want to achieve. Do I want cash flow? Do I want protection? Or do I want to speculate? What do I want to do? Excuse me. So The personal statement, if you went through the fundamental pillar, first I make my decisions based on what I want to do, my age, where I'm at in life. When you get with a good financial advisor, if they're any good at all, they sit you down with a suitability inner. So I love that. Okay. Corporate would be a good one to do if we're going to buy a gold company or mining company, right? Would be a good one to do. And of course, sovereign is where we're going to get our opinion on gold, right? So today we're just going to do two, because we're going to go directly for gold. We're not going to buy a gold company. We're going to go for the throat. So tonight we're going to execute the 4 pillars first with personal and sovereign. If you like if you like the idea of applying this knowledge tonight, say I love application. Put it in. And John, Paul, you can just say, I agree, or raise your hands, or whatever. Okay, I love application. So we're going very, very fast. In fact, how many of you guys, I'll put the hands down. There's a little icon that lets you raise your hand. If you can't find it, you'll figure it out eventually. But how many of you are new students? Like you're just like within a week? Okay. Well, quite a few of you. Okay. How many of you feel like you've hit a whirlwind of knowledge on Sunday orientation, and now all of a sudden we're Tuesday? Wow, we're going fast. So I said quick start. We're not screwing around. We're going. So that's the fundamental analysis. Let's make that small, and we'll do corporate and personal. Okay, now, who can tell me what technical analysis is? What am I going to bring up next? What do you think? Take a guess. What am I going to bring up next? Yep, I'm going to bring up a chart. You guys are freaking fantastic. So technical analysis is looking at the chart. And this is a chart of gold futures right here. And we're going to look at some charting behavior to get some ideas on how we're going to do these things. So you're going to see us apply fundamental analysis, technical analysis. And I get a little emotional. Please forgive me for that. I'm struggling a little bit because I got so many people looking to me right now, and the pressure is unbelievable because I have to teach you so well, so fast. But I get emotional because I'm excited for you, because I'm going to tell you what, by the time we're finished tonight, I'm going to ask you a question at the end. I'm going to say, how many of you are already seeing how the 4 pillars work? How many of you are already seeing how solid these are and how this is the best way to learn it? And even though some of you are only in your second or third meeting with me, you're already going to say, Andy, this is like magic. Okay, this is like magic, even though you're brand new. So I get a little emotional about that because I know these pillars help people learn. So you guys are exactly right. We're going to look at a chart of gold. This is a gold futures chart. We're going to talk about spot price, gold futures, gold bullion, gold ETFs. We're going to talk about silver and gold, and we might even sing the song with Burl Ives before we're done. So that's that. We're going to take that down, and we'll cover that when we can. Okay, cash flow, that's the next pillar, and we're going to look at different ways to use gold, things gold might be good at, things gold might not be as good at. I don't have coronavirus that I know, guys. I took a flu test on March 2nd, got tested positive for influenza A, and then my doctor said, dude, it's just hanging on, you're fine. I've gone and seen him twice since I was diagnosed. He said, no, you're fine. You just got a little flu hanging on there, so no worries for Andy. And that's the cash flow. And then finally, we're going to do a risk graph right here. And here's the risk graph. So we'll have all 4 pillars tonight covered. So I'm going to move these off, and we're going to do them in order. And with that, Corey, what do you have to say about gold? I mean, what do you have to say about this?
Yeah, all that glitters is gold. I think gold is an obvious beneficiary of money printing and currency devaluation around the world. And that's not just a U.S. problem. That's a problem everywhere. And gold is really a currency. I mean, when you think about it, it's just a shiny metal. It's not a productive asset. It's not out there generating revenues and things like that like a business is. But it's a form of value in terms of stored value. Even countries will use it. They'll store gold and do things like that. And what's happening in the world is what we're about to go through, which is currency devaluation. When you think about what your currency is going to be worth, with them devaluing it, you have to make an assessment for what are some alternatives to that. What are some of the things that benefit as currencies lose value and are printed dramatically, and that's where really the precious metals come in.
So Corey and I, in the 4 pillars of investing, one of the assignments we've given you, okay, is that we say, look, you want to conduct a fundamental analysis on the United States, okay? And for whatever reason, look out, this thing I think more than one person might be looking at this these days. Look at this thing, man. It is maxed out. So how many of you have already, and let's write this out, how many have already, I just want to see how many binge people there are. How many have already gotten through the first pillar, and you've already gotten to the point where I said, okay, here's this national debt clock stuff, and you had to do this. Say aye. Let's just see if anyone's got that far. Yep, Matt's there, William's there. You guys are, oh my gosh, Patrick's 3/4 through. Aye. Fantastic, guys. Oh my gosh, Marvin's into the 3rd pillar almost. Okay, fantastic. Leela says, yeah, I'm through it, but I started in October. Good for you. Alexander Rodriguez says, I just got in today. Great job, Alexander. So I'm going to give you a little head start right here. Karma says, I've done this many times over, so great job, you guys. Let me find my pen tool. I didn't have that up here, so let's see if I can find it. I've got so many things always open on my desktop, Corey, that I never know where anything is at. It's so funny. Preferences. Let's see if it even... all I'm doing right now, guys, is I'm looking on my other monitor for my pen tool because it gets buried by stuff. There it is. I knew I had it somewhere. So right here, we're just going to do this very, very quickly. This shouldn't take long. The income of the United States from taxes is $3.4 trillion and dropping, right? It's dropping. The spending official is rising, and it's at 4.6, and it's rising. That means the federal budget deficit right now, if you can imagine this, it's this math, is this even right? 3.4 to 4.6. That's a 1.6. Am I seeing this right, Corey? Have we gone from 1.2?
Yeah, that's not the... So I wonder what...
Oh, no, I got the wrong one. It's this one. That's right. I about had a heart attack, so I'm like, there's no way that jumped. I know it's bad, but there's no way it jumped $400 billion in 2 days. Okay, so 1.6 trillion deficit and climbing. Okay, they claim your house is theirs.
You mean at 1.2 because we grabbed the wrong
1.2. Thank you. 1.2. Yep. They claim your house is theirs because they could always do a national property tax to pay debts. And I have a little tiny business that's insignificant, but I'll tell you what, they'll look at that bank account and say, oh, we could just tax Andy's businesses more. So whatever national assets we have that belong to us, even if you have a HELOC on your house, well, the bank owns the HELOC and the U.S. owns the bank. So, their assets are really yours. They don't have any assets. It's your assets. So if you believe they're yours, like I do, which is false, I put a 0 there, but they would put a lot there. And then we have this issue very quickly. We have 23 trillion very quickly, 23 trillion and rising, and that's money that's already been borrowed. And then over here we have 132 trillion that we've promised in Medicare, Medicaid, entitlement programs. That's not money we've borrowed. We haven't written any bonds for that. We haven't sold any bonds. The U.S. Treasury hasn't, said, here's a Treasury bond and got that money to buy this yet. This is just coming down the pipe. That's what we owe coming down the pipe. So that's a fundamental analysis on the United States. If you looked at that and it was a corporation, how many of you would invest in that corporation if you looked at that? Let me see yeses and nos. Who would invest in this corporation if it were a company? Not one person. Well, guess what? People are. And the reason people are is they're buying treasury bonds, which is an investment, and they believe they're going to get it back. So even though there's not one person on this whole thing I can see except Antoinette Foy, who says she would. She says, I'd buy a bond right now, but not very many people would. Well, I might. And the reason I might is they can pay the bills better than anyone. The reason they can pay the bills is whatever bill they owe you. How are they guaranteed to be able to pay that bill? Do these guys work for money, or do they print for? Oh, Tom's got it. Oh, so they can pay. And so Alan Greenspan is actually correct. Alan Greenspan, when the U.S. lost their AAA credit rating under the either it was the Bush or Obama administration, I can't remember which one it was, but it was between those two guys, and they lost their credit rating. Alan Greenspan freaked out. And he went on CNBC Live. He said, look, the United States can pay its bills, meaning bonds, because they can always print money to do that. There's no problem with it, right? So good for them. So that is basically a fundamental analysis on the United States. Did I say we could do it in 5 minutes? If I don't have to explain it, I can do it in 2. So how many already think this is pretty cool? Type in pretty cool, right? This is pretty cool to learn. So we start with that. So we know that they're probably going to have to print some money if they're going to do fiscal stimulus, and if they're going to start putting out all this money for coronavirus help, they're probably going to have to do some stuff. So that's when we bring into monetary policy. Corey, why don't you take this one and talk a little bit about the mandate quickly of the 3 things that that they look to do in terms of this stuff here. Go ahead and talk about that, Corey, if you would.
Yeah, so the Federal Reserve has a couple of major mandates, and one is to keep prices stable. So that's talking about inflation, right? And what the central banks have really been worried about recently has been deflation, which is instead of values going up and prices going up, kind of what is happening with oil. Oil is in a deflationary mode where its prices are going down and so forth. So they want stable prices. They want to keep the rates, the moderate on the rates. And then they also are in charge of full employment. And they try to keep, the employment picture strong. What we're probably going to see is a massive, so on Thursdays, you get the numbers for those claiming to be unemployed, and that number is expected to skyrocket this week because of mass layoffs. And so what the central bank is doing, what the Federal Reserve is doing, that's one of their mandates, is to try to keep full employment. So what's happening? Well, they're trying to come in with a rescue package, trying to come in and say, okay, if you'll keep people employed, we will cover those wages for a period of time and so forth, because that's one of their mandates, is to keep full employment. They try to keep prices under control and stable, and then they have reserve requirements. That's bank lending. The Federal Reserve sets a monetary rate that basically this rate is what they lend back and forth with financial institutions. So that discount rate is basically lending that takes place where they can lend money to banks that need some money temporarily, and that's the rate that the banks have to pay them.
And in reality, thanks, Corey, and in reality,
Yep.
So they can mess with that rate and take it to 0, and that passes that on to the banks, which encourages them to lend and encourages people to borrow. Same with this fractional reserve rate. You'll learn about that more in the 4 pillars. We're not going to go it tonight, but basically what we're saying is the big thing they're going to do, and that they've done in an unprecedented way, I've never seen this, is print money. So I'm going to cut right to the chase on this. You can learn more about it in the 4 pillars, but for our purposes here, we're going to look at Ben Bernanke. Does anyone know who Ben Bernanke was? He was the chairman of the Fed before Yellen. Most of the Bush and Obama administration, I think it was Greenspan and Bernanke. And he said this, and I don't know if I can make this big or not, probably not. He said that, what has all this got to do with monetary policy? Okay, like gold. So what are we talking about tonight? What's our subject? What's going to be our investment tonight? Our investment is gold, right? So just like gold, U.S. dollars have value. Now watch this. Only to the extent that they are, what, everyone? Strictly limited in supply. He didn't say limited in supply. He didn't say loosely limited in supply. He didn't say sort of limited in supply. He said this has to be kept strict or tight, or whatever strictly means. I got strictly. I guess I should look up strict. There we go. That's a little better. demanding that the rules concerning behavior are obeyed and observed. So you got to keep the rules with this stuff, apparently. Exact, faithful, accurate, very careful, very meticulous in terms of limiting in supply. But, and the word but negates everything you just said. You ever said, like when my wife comes, she says, Andy, you're a nice guy, but, well, now it doesn't matter, I'm a nice guy anymore, right? You know, all you nice single people out there getting set up on date, she's really, really nice. But, well, now it doesn't matter that she's really, really nice. So the U.S. government has a technology called a printing press, or today it's an electronic equivalent that allows it to produce any dollar that it wants. So hence the strictness and the discipline, because if you, by pushing a button, can make as much money as you want, you can print and you can produce dollars in a second. I mean, look at the difference between you and the Fed right now, okay? Like right now, I'm going to be talking a little bit about personal fundamental analysis here in a minute when we get into the trade. But right now, a lot of you guys are saying, okay, some of you are first you're saying, is my income going to be there? My brother's a policeman. We're going to need him. My brother-in-law's an ER doctor. We're really going to need those two guys. I mean, those two guys, it gets me emotional because they're the heroes in this thing. They're out on the freaking front line risking themselves. I want them home safe to their families, right? My brothers, they're out there. They're probably going to keep getting paid. But then I look at other people that I know, and for all I know, they lost it. They're going to be part of this big unemployment wave we're going to see when the numbers come out on Thursday, right? Isn't it Thursday they come out, Corey, that you said?
Yep.
Yes, Thursday.
Yep. That's the jobless number.
And so the people that lose their income, the first thing they're going to do is look at their old money. If you're bringing in new money, look at your 401k money. That's money that's old. Well, the problem with old money, the reason I wrote a book called 401 Chaos, and the reason I hate 401ks is it's not your money anymore. And when this happens, when the income stops and all of a sudden all your money's old, try to get to it. Try it. Give it a shot. Because if you pull out that 401k, it's 10% now. You got to buy that money back from the real people that own it, which is Wall Street, charging you fees, right? And so that's a tough one. Or maybe you bought some gold and now you got to sell that. Or maybe you put some money on the mattress, you got to sell that. Or maybe you got some real estate. Okay, try to sell that. So when you look at new money shutting off, now we say, okay, how much money do I have that's old? And that creates an hourglass, number one, of how fast that might go. And then number two, if everyone that lost their income is starting to sell assets prices drop. One of the reasons the market has fallen to pieces in the last week is people have debts to pay on Wall Street, and they know that they might have to sell those assets, and they'd rather sell them now than later. And because, the bills won't stop. Would you agree with that, Corey, that that's one of the reasons they're selling assets, because they're probably in hawk somewhere in some derivative, and they got to go to cash to pay their bills. Would you agree with that, Corey?
Exactly right. Selling begets more selling. So It's kind of a situation where in many cases, they probably don't want to sell some of the things, but they're forced to do it.
That's right. I've been in that.
Forced liquidation. Yeah.
As a trader, I've been in that situation so many times, and really that's the danger of your margin call right there, because you might have some investments like we're going to do tonight that are based on time decay, where they're negative now, but it'll be positive in a month. But if you have to liquidate and sell while they're negative, you're going to lose money if you're forced to. And when I was first trading, one of the mistakes I made is my position size got too high. Market moved. I did a margin call, and I had to liquidate things I didn't want to sell to pay my debts. So position size is going to be key. Now, if you lose your income and lose your assets, now you're asking, well, do we have a HELOC? Can we borrow against the equity in our home? Do I have a credit card? What's my limit? And so that's the thing. How many can see that little pathway to bankruptcy? You lose your income, you lose your assets, then you max out your credit and you're done. How many like this little lesson right here? Let's see it. Say, I like it. If you think they should teach this in grade school, say they should teach it. Okay? So we're learning a lot. So that's a personal fundamental analysis, right? What do I want to do? So that's why this is so important right here. So the U.S., wouldn't it be nice if you, right now, the U.S. doesn't have this problem. They don't have to worry about income. They can just raise taxes, right? They don't have to worry about assets because they can raid yours. And they don't have to worry about borrowing money because they can print their own to pay their bills. So, if you could do those things, maybe your financial statement would look like this too, because who's to stop them? They don't have to do any work to get income. They just tax you. They don't have to do any work to get the asset. They just claim it, right? I mean, the municipality says, oh, you got a nice house? Okay, give me some property tax. Well, I worked hard for this house. I don't care. Give me some of the value of it right now. Oh, look, you have a big, nice home. Oh, I'll take some more of yours. And when it comes to liability, it's like, oh, borrow as much as you want. All you got to do is vote for your credit limit. You don't have to go to a bank and say, will you raise my credit limit? They just vote. Yeah, let's raise the debt ceiling. And then if they want to pay off this stuff, they can just print money. So if you had no constraints and no value you had to bring, well, no wonder we look like this. No wonder we look like this. Is this making sense to you guys? Say yes. And yes, John Paul, that's exactly the spot where you can answer and ask these questions. Yeah. Okay, this makes sense so far. So the discipline of being strict is really important. Well, if we increase the number of dollars in circulation, and right now they are credibly threatening to do so. They haven't done it yet, but they are definitely credibly threatening to do so. The U.S. government can reduce the value of a dollar in terms of the goods or services it buys, which is equivalent to raising prices of the goods and services. So it's inflation, basically. It's inflation. And if I could size this up, we could see the whole slide. So instead of sizing it up, we will take this down to fit the slide. And it just means inflation, right? And I'll let you go through the 4 pillars course to understand this in detail. But basically what we've got here is an announcement by the Fed. So we can go through this quickly. We don't want to spend the whole hour on this. Is we've got a real interesting statement where Ben Bernanke's Fed of back in 2002 when he was a governor of the Fed, before he was chairman, he's still a Fed governor. He says that we should what? Strictly limit this in supply. Strict. Very, very strict. Now we're saying, instead of being strictly limited, we have what? No limit to support the markets. So I don't know what word to use for that. Who has a word? Is it a dichotomy? Let's pull our students here and say, okay, what does this mean? When they say one thing over here, strictly limited supply, and then it's really important to keep from inflation, strictly, and now they're saying, nope, no limit. There's no limit to the amount of money we will print. So someone said contradiction, hypocrisy, a conundrum, mind-blowing is what Tom says, an oxymoron, ugly, short-sighted. Marianne, holy cow, Marianne. You know what? I think I really like Marianne. I'm not going to tell you what she said, but I like your style, okay? Okay, we've also got the same thing from James Rayleigh. I didn't know, this is a rated R group. You guys are terrible, okay? Fantastic. So someone says, ask the other countries how this has worked out. So how many can understand?
I got a word for it. How about Ponzi?
Ponzi is fantastic. That might be the best one of us all. So how many are glad you're here tonight, and how many glad that we're talking about gold now? And can you see why this is cool? So what's interesting about the Quick Start Labs, they're the only classes I do live. We do them once a year. We do record them so you can go back. But what's cool is we've been recording this is this our 6th year or 5th year, Corey? I think it's our 5th year. And there's probably 40 hours of stuff where you can go back and you can see what we're talking about, where the goal is to learn the 4 pillars. And you can see historically how the 4 pillars don't change. No matter what environment we're in, you learn these 4 pillars, and hopefully it'll give you some guidance on what to think, how to do it, all that type of stuff. So no question that the US dollars are kind of like what? Gold. Well, here's what's interesting. Gold is like US dollars because gold is what? Very limited in supply, because you got to dig it out of the ground. It's hard to get, man. It's dig that stuff out, smelt it, find it, assay the rocks. My grandpa used to do this stuff. It's a big deal. And so that brings us from fundamental analysis to what? Technical analysis. We think that it's quite possible that as the dollar goes down, perhaps maybe people would be interested in putting money other places. And so if you were going to have the value of your money go down, How many of you think, well, I want to get rid of that money before it goes down and buy something else? Who wants to get rid of their money and actually get something else and go down, right? Okay, yeah, so if we predict that, hey, and I'll tell you, I won't give recommendations, okay? From an educational standpoint, I've never talked with my family much about this stuff because, it's none of my business what people do, and I'm a private guy. But I will tell you, I'm looking at my situation. I say, okay, I got some stocks over here. I got a real estate over here. I got a business over here. I got some gold over here. I got some currency over here. I actually, for me personally, feel a little comfort in having a little bit everywhere. Like whichever one, might work out. I just want to have a little in that area, right? I don't like diversifying across the stock market, but I do like diversifying across asset classes. That's just my opinion, and I could be dead wrong about that. But for me, that's the way I'm attacking this, right? That's the way I'm going after it. So right here, explain what a gold future is, Corey. Could you explain what they're seeing right now with this gold futures?
Yeah, so futures are kind of, the word future means future delivery. And so when you get into the futures market, you can basically say, well, I want to lock in future cost or future delivery. And let's use a scenario here. Who might be buying gold futures and who might be selling them? Well, if you're a company, let's say one of the gold mining companies, you're going to pull gold out of the ground, but you're at the mercy of the markets as to what you can sell it for, right? And those prices are going to fluctuate. And so a gold mining company might hedge their exposure. And what they say is, well, I'm going to pull it out of the ground, but I want to know that I have a locked in price for some of this. If I like 1671, which is where it's trading right now, I might go ahead and sell some futures here, which means at a future date, and they could pick May or June or July, whatever time frame, they could say, I want to go ahead and lock in my price where I can sell this gold. And so they would go out and sell a futures contract, and they would lock in a guarantee of being able to collect 1671 for that ounce of gold, so that in case gold plummeted, as a gold mining company, they have a locked in sell price at 1671. Now, they would take exposure on some, but this might be a hedge. This might be a way for them to take less risk, that they would know they have some locked in, because if they know they can pull it out of the ground and the cost to pull it out of the ground costs them $800 an ounce, they may want to guarantee at least 1671, right? So they sell some of those futures to lock in a sell price. Other people might want to lock in their buy price. They might say, well, I'm at risk, or I want to speculate on gold going higher, so I want to lock in my future price to be able to buy it at 1671 no matter where it goes. And if it goes up to 1700, 1800, 1900, their futures contract has gone up. They didn't have to own the gold. They locked in the ability to buy it at that price in the future. So futures are kind of created for that reason, where people can lock in a buy price or a sell price for a commodity or some market at a future date.
I think it's funny because if I'm a gold mining company and I do that, I'm making a pretty big assumption that there's still gold left in my mine. To go out and get stuff done like this before I even have gold is an interesting idea. So you can, but here's the big point. In the last 4 days, since we've seen the measures of the Fed have come out, and in the last 4 days, we've seen, huge increase, and we're sitting here, and this is technical analysis. So now the first thing we notice here is, let's see if anyone's been watching their technical analysis videos. And if I were to draw a line right here, who in class can tell me what line did I just draw? Does anyone have you guys are so good. Okay, now this is cool. How many of you are seeing this and you just learned how to read that on a chart within the last 5 days? Put on how many days you're in. Put in how many days ago you learned this. How many days ago you learned it? Put it in. 2 days ago, 3 days ago, 4 days ago, day 3, day 4, day 5, day 6, 10 months you've been with me. Just got in today, Janet says. And you guys are all, just joined this afternoon, Kathy says. You're already learning how to read a chart. So this is called what, Corey? Oh, he's muted. We lost Corey. He'll come back.
That's resistance.
That's
Hope you can hear me
resistance.
now.
So what's interesting is, it pounded on it once and backed off, pounded twice and backed off. This is a reverse cup and handle. This is usually half of an inverted head and shoulders. This might come back. But what we're looking to is if this booms through, the old support often becomes the new, or the old resistance often becomes the new support. So right now the market has been resisting this price of 1700. Now, traditionally, Corey, I don't like buying at the top of the market necessarily, and I certainly don't like buying after an inverted cup and handle. But under the conditions, I need to look at the fundamentals we just looked at and what change may have happened since this resistance, right? This is old monetary policy. This is old monetary policy. Well, guess what? We now have new monetary policy. And I think to myself, I don't like usually buying right here. That's usually not a buy. But I'll tell you, if it breaks through, like if I shot a gun and it didn't go through the ceiling and I shot a bullet here, so I got to get my cannon and it shoots through, we could be in for a run to the upside now. What is your technical analysis on this as you look at it, Corey?
Yeah, exactly right. So we're kind of bumping our head against that resistance. We have a couple of choices. If you're going for price direction, traders would typically wait for the breakout here. They would say, if I'm going to play this in a directional manner, like you were talking about, I'd probably wait for it to break through 1700 to make sure we've cleared that hurdle. And then I'd feel confident that, hey, this thing can take off and it can run in my favor. What often happens around resistance is, maybe it pauses here and kind of backs up a little bit and then goes through at a later time. So what we're going to show is a way to basically say, well, maybe I'm not even betting on it going up so much. I'm just going to bet on it not going down a lot. Now, that's a different concept. I could make money whether it goes up, down, or sideways, as long as it doesn't go down a lot. And that's the type of strategies that you can do in the options market. So where it's against resistance and might kind of bounce around there, we ultimately do think it's going through 1700 sooner rather than later. But we'll show you a strategy where you can actually say, I don't need it to go up. I'm just betting it's not going to go down a lot from here based on the fundamentals and based on the fact that actually think about it this way as well. Something we call relative strength. That's another technical term. When you're looking at these technicals, you say, how strong is gold compared to other asset classes? Is the stock market anywhere near its highs? Absolutely not. Is the bond market's not even near its highs? If you look at corporate bonds and so forth, if you look at various asset classes out there, it's really hard to think of anything that's up here at the highs. So relative strength is basically a comparison game. How does gold look compared to other asset classes? And I would say pretty darn good. It's acting quite well and up near the highs, which is a sign of strength, a sign of that it's been under demand, and a sign that it's probable that it will go higher. That's a technical take.
Absolutely fantastic, Corey, analysis there. Let me see if you guys are catching this. I appreciate how you've entered so many things in the question box. Put this in the question box. Right now, so far, if I went out today and bought some gold, do you think I'd be buying it because I think the price is going up? Or do you think I'd just be buying it because I'm concerned about my currency and want to have some gold? Do you think it's more speculation on direction or just some insurance and peace of mind? What do you think it is right now? You think it's because you think I think it's going up, or I just want insurance? Okay, fantastic. Yeah, I just want some peace of mind right now. Technically speaking, this is not a chart that excites me about gold until it, like Corey said, until it breaks out. Of course, the relative strength that he mentioned is a huge factor. So that's why we have both fundamental analysis and technical analysis. So we've done our first two pillars. Now, let's talk about cash flow for a minute. and we're getting we're doing so well on time. I'm so proud of you guys. You guys have done a fantastic job tonight. Let me just see if I can bring out one of these. And I'm going to give you a little personal fun. We're going to go back to personal fundamentals for a minute. And I'm just going to see if I can't copy that and just paste me like a whole bunch of them here. In fact, I might just have to do it this way. Just take a picture of it. That's one way to do it. Just kind of bring it over here and shrink it down to size. And let's get one more. Bring it down to here. And let's shrink that baby down to size. And Corey mentioned this at the top of the class at the beginning is, I said, is this sovereign fundamentals or personal fundamentals or corporate? And a lot of you guys said all three. A lot of you guys said both. A lot of you said sovereign. So I'm also going to do a personal fundamentals. And I said that of all three types, personal, corporate, and sovereign, what's the most important one? Does anyone remember for the four pillars, which one's most important? It's personal. I don't really care what the government's financial statement looks like. I care what mine looks like. There's people over in Greece, and Greece's financial statement got its butt kicked. It's pretty ugly. But there's some people in Greece that are living a wonderful life because personally they're solid. So I really don't care what what my country's financial statement is. I care whether mine is solid. Of course, I care a little, but mine's the one that's the most important to me. So you'll notice that if we put gold in here, right? We put gold in here, and we put gold in here. An investor might have different reasons to do it. Okay, so I'm going to put myself here for my reason. Is I also have cash in here. And so my thinking is, well, if the gold goes down, like let's say I buy gold at $1,700 an ounce today, okay? And tomorrow I wake up and it's $800. I'm pretty happy because that means my cash is probably even more valuable than it was yesterday. But if I wake up tomorrow and my cash is only worth half of what it used to be, there's probably a good chance that my gold is worth twice what it used to be. So really what I'm doing is I'm spreading around my wealth here that if, like a teeter-totter, that if one goes down, the other goes up, and if the other goes up, the other goes down. And I have a little teeter-totter here that no matter what happens is they'll equal each other out. And that's just a theory. That's not always true, but historically it certainly seems to have been somewhat valid. And so, every dollar I gain going up here, if this gets pushed up, well, I'm losing over here, but that's called a hedge, where I have two assets that are non-correlated and oftenly inverse correlated, not all the time. Sometimes both go down and the teeter-totter breaks, but at least I feel they're good. So for me...
Yeah, and I think that's a great point, Andy, and I would say this. Historically, which one has continually gone to higher prices over the long term, and which one has continually gone to lower prices or been devalued? And if you look at it from that standpoint, every year that you're holding currency, essentially, if there's inflation, your purchasing power is going down. Meaning, everything that you buy today, we assume, if it's like history, 10 years from now, those same goods and services, that same amount of goods and services will cost us more. In other words, our cash has gone down in value, right? It doesn't buy as much. And so currencies have consistently lost value. And that's why we see, use the NFL as an example. What happens with the contracts that they sign? Well, they're constantly going higher and higher. I was a fan of John Elway. John Elway probably made, at some point he made $2 million a year, and people flipped out. Wow, can you believe he's making $2 million or $4 million? Now they're making $35 million and $40 million. It's inflationary. And gold maybe hasn't been as good historically as stocks, but it has consistently gone up in value. Go back 2 decades, a decade ago, 2 decades, 3 decades ago, gold cost less than it does today. And so it's constantly on that upward trajectory. whereas your cash is constantly on that downward trajectory long term. Of course, there's little pockets of changes, but longer term, that's always kind of the trajectory they're on.
Now, watch this. If a person has this type of education, someone might say, I want to have a year's worth of cash to live on, because I know, like, let's say you really pay attention to that lesson I just gave you. Like, if income is gone, then you got to go to assets. And then when assets go away, you got to go to liabilities to pay your bill. If you understand that lesson, say, I understand, Andy. If income leaves, then I got to go to assets, then I got to go to liabilities until I'm bankrupt. Okay, I got that. Now, let's say that you'd have been taught that lesson from me a year ago. Let's say you've invested, a little bit in your financial education here, a few bucks in your education. How many of you, if you'd have learned that lesson of, if my income goes away and I still have expenses, I might be forced to liquidate some of my assets that are hard to get to. How many would have thought, you know what, I'd rather have maybe a year in cash than paycheck to paycheck 2 weeks? And who might have said, I understand this, I'd probably buy less doodads and I'd probably do this. So how many are going to take from this experience, wherever we wind up, that you're going to think, I'm probably going to learn these lessons for coronavirus, and actually coronavirus and this course might be a life changer for the next 20 years for you and how you see about this. You see that? Now watch this. So if you know that lesson, you'll say, I want to have a year of cash before I have to start liquidating assets. Okay, but watch this. What if you also said, I not only want a year of cash, but rather than going out and buying a doodad, I'm going to buy myself a year's supply of gold. So I got a year's supply of gold, a year's supply of cash, both. Who likes that idea? Okay, that's pretty cool, right? Someone says, I'd rather have both. And then, someone just said, wow, I just got a wow out of James Looney. But the only way people have the foresight to do this type of stuff is if they've had financial education. You see that? That's the only way. And to tell you the truth, I'm not a prepper. I don't have a bunker out somewhere or something. But my wife and I just moved to a different place, and we were looking at all our old food storage. The year's supply of food type stuff. So I'm not a prepper. Preppers are extremists, but there's nothing wrong with having some of this stuff, having a little real estate, having a little gold, having a little cash, and having a little bit of this stuff. Now, where I do not really get off on this, where I really don't care about this, is trying to do this, is increase my net worth by hoping the price of gold changes. So right here, I might take money as a speculator, and I might say, well, I'm going to buy gold at 1,700, speculating that later I might sell it at 2,100. And if my asset goes up $400, well then my net worth just went up $400. Good for me. Then I sell, and this is the buy sell game. And you'll notice that if I had a rental house here, well, that collects rent. If I have a stock right here, well, that collects a dividend, right? If I have a business right here, that makes sales. But if I buy gold, it sits there. It's shiny. It's fun. I like to look at it, but it does not cash flow. So as an investment, I have to understand that gold does not cash flow, but it will do this. So over here, my mentality is that if I go out today and I buy some gold, that money hopefully is just gone forever, and I just stick it there in the gold, and the best case scenario would be that I never see that money again. The best case scenario with the gold I bought today is that I watch the gold price go up and down and up and down and up and down forever. And I die, and my sons inherit that gold. That is the best case scenario. So I put money into gold. If I do put money into gold, I have to really say, that's not cash I'm going to want or need for another asset. That's my philosophy. Now, you can do whatever you want. You can sell your gold anytime you want. You can trade it, whatever. But how many can see the difference between insurance gold, because that's really what it is. Hey, if I bought car insurance last month and I didn't use it. I bought home insurance last month and I didn't use it. And I'm going to buy currency insurance this month and I may or may not use it in gold. How many are learning a different way of thinking about investing, even in this first quick start lab. Are you seeing this? Yeah, I keep the gold in case. That's exactly right. You know what? We have Donna Reed. I'll bet you get that all the time, Donna Reed. We have the Donna Reed. Donna, it is a wonderful life, isn't it? I'm sorry, Donna. I don't mean to do it to you, but I know you get it all the time. Okay, now, what we're going to do in the last half hour of this, or the last 35 minutes of this 90-minute quick start lab, what are we going to do? Sometimes we can go an hour, sometimes we go 90 minutes, is what if I did want to cash flow gold? What if I'm not interested of having it in an asset? I'm not interested in insurance. I just want to cash flow gold. Well, let me show you some stuff here, okay? Let me show you some stuff. You guys ready to cash flow some gold? See, I'm ready to cash flow some gold and make some money on it. You ready to cash flow some gold? How in the heck do you cash flow gold, Corey? You must be a genius figuring all this stuff out, right? Actually, Corey and I has been cash flowing gold. I don't know. I get it. You know what, Corey? I get so confused between our joint account and our account we do in paper. I know on our paper account on Monday we cash flow some gold, and I know those did really well this week.
We have done some gold in our main account as well. Yep. So we use the options market. We use the options market to cash flow, and in the options market, what's really interesting, and maybe there's a couple of ways that we can show this, but we typically use GLD.
Yep. And I want to bring, and I'm going to bring that up now. No, before I bring it up, I'm going to have them note the price roughly of gold now is about 1674. Is that right, Corey?
Yeah.
Before I show them the GLD,
the future,
so just everyone remember that the spot price here for gold future is about 1675 right now, and it moves 24/7. Man, this is not a market that closes. Because around the world, gold is kind of a big deal, right, Corey?
That's right.
Now watch this, though. I'm going to show you something that's kind of interesting. I have a friend that I usually buy my gold from. I'm not buying it from him right this instant because he's out. So I have a friend named Mike Maloney who owns a company called goldsilver.com. Mike's been on my podcast. It was really fun. Mike Maloney is like my son's heroes because he's so nice. When my sons, they have a little silver, and for Christmas I'll say, "What do you want?" They go, "Dad, can I get a little silver?" And sometimes when they had a little lemonade stand, and they take the money from the lemonade stand to buy silver. And so when we went to buy our silver for the first time, I whipped out I set it up. I showed him a bunch of Mike Maloney videos and Mike Maloney books. This guy's a genius. He has taught me more about the Fed currency devaluation. Of course, he's a currency guy. He sells gold, right? But it was funny because I had him watch a bunch of videos on Mike before they went to it. And I said, "So what do you think of Mike?" They go, "Man, he's awesome." I go, "Well, let's see what we should do." And I called him. They didn't know I knew him. And so I call Mike Maloney, and he gives my sons on speakerphone their first lesson on how they see when you look at precious metals and you've never bought them before, you've got a lot of choices here on, junk silver, silver eagles, silver rounds, all kinds of different silver coins. And, that you have every single, not anymore. Wow, that means that, look at this. Due to a surge in demand, all products, that means everything he's got is back ordered up to 12 weeks. And there's a temporary $1,000 delivery order minimum. So if you can't buy something for $1,000, you can't buy. So you can't go get a couple of these, right? Like this little 1 to 19 thing here. You got to spend $1,000 with him or he won't even talk to you. And it's 12 weeks before you can get your stuff. Now, think about this in terms of coronavirus right now. Okay, how many think the world could absolutely change in 12 weeks? How long is 12 weeks? What's that? 3 months? 2 months?
3 months, yeah.
Something like that. Think the world might change in 12 weeks? And so he's backed up for 12 weeks right now. See that? And
they're acting like gold and silver is more valuable than toilet paper.
We've had a few people say this is like toilet paper right now, except I'm not going to wipe my nose with toilet paper or with gold.
Yeah.
Okay. Now,
you only use gold for that. You only use gold.
This is an interesting thing. Right now, he's not even showing his Canadian Maple Leafs. I mean, maybe they're somewhere on the site, but I'm not seeing Credit Swiss bars. There you go. So this is a Credit Swiss bar right here, okay? And this is 10 ounces, okay? One day, I'll tell you a funny story about this. One day they had career day at my son's school. I think Zach was in like the 5th grade or something, a few years ago. And it was career day, and Dad was supposed to come and talk about what he did. And I really don't know what I do. I'm still trying to figure that out. But I gave him this little lesson like I gave you guys on assets and liabilities. And I said, look, there's 4 asset classes: business, real estate, stock, and commodities. And I brought this 10-ounce bar of gold with me, and I passed it around the room and let him feel it. I didn't tell him how much it was worth, but I let him feel it. And they had these rotating classes, Corey. By the time I was done, that thing was packed wall to wall. At every 4th grader in my class, they had no idea what I was talking about, but the word got it. There's gold in there, dude. And he let you touch it, and it brought everyone in. So this is a Credit Swiss bar, very reputable. That's the thing. The Golden Eagle, the Canadian Maple Leaf, the American Buffalo is kind of a collector type of deal. How about that one? That's only $700,000. How about a 40-ounce gold bar, Corey, for $700,000?
That's crazy.
Should I just add that to the cart and I'll get it in 12 weeks? Okay. Jeez.
So you'd at least meet the minimum for an order. So there you go.
So the gold that I'm looking at is, notice this. He's selling the common date 1-ounce gold American Eagle or Golden Eagle, and this is why I brought this up. The spot is 16. He's selling that $300 over spot right now. See that? Now, another thing you want to know about buying this bullion is if you take this 19 right here, okay, and what you do is you say, okay, he's charging me 1908.97, and I divide that by 10 to get 1/10 of an ounce. Divided by 10, I get 190. So why is he charging me another $25 per coin? And understand that's 25 times 10. So it's $250 more to buy these 1/10 than it is to buy this. Well, that's because this stuff's hard to cut up, number one. And if you're out there trying to exchange for gold, well, a $200 unit's nice. That's like 2 $100 bills. This is like 2 $1,000 bills. And there's just more people that can afford, I think, $217 than $2,000. So that's interesting stuff. This is gold bullion. Well, will I pay these prices? Well, I might have to if I want gold bullion. But remember, for me, once I buy it, it's my grandson's anyway. And I don't worry so much about this if I really want gold badly, because I'm probably never going to see that money again anyway. I mean, I care about prices. Of course, cost basis is important to a trader. But if the world goes to hell, this is probably going to be worth a lot more there too. So this to me is a bunker mentality, extremist, crazy Andy stuff. Don't get nuts like me. But is this helpful for you guys to just get a little exposure? I'm not a gold expert. I leave that to my buddy Mike Maloney, but this is what gold bullion looks like. And so, I don't have as much gold as I want. Who does? But, I have some bars, and an assortment of this. And then my sons and we, silver, and we have a little, not a lot. I don't have a lot. I wish I had a lot more. I have a little. But I have enough that I can kind of say, okay, I always wish I had more, but at least I have some, okay? That's not what we're doing. What we're doing is we're going to do an ETF. Now, there's a lot of conspiracy. Like a guy like Mike Maloney would just think, I'm swearing as far as he's concerned right now. I mean, this is sacrilege. Putting money in a gold asset that isn't gold, he'd be very upset with me right now, because all the gold guys, what do they say about GLD? What do they say about it, Corey?
Yeah, they probably don't like that too much. Number one, because you're not buying from them.
Yeah, well, I would say that's true. Yes.
but they probably don't like the fact that you don't have it in your hands, and their argument is
Paper.
probably the end of the world type of thing, where you only have a commitment to have that, but you don't actually have it to touch and to feel, and so they probably don't like that too much.
And it's funny because I had another friend who's wonderful, and he won't mind me telling this story. And if you can't get gold from Mike Maloney, Google Anthem Blanchard, and he sells gold, and he's a friend of mine. And he does the same thing Mike Maloney does. And, if you're going to, and like what's funny is where Mike Maloney stores his gold is actually at Brinks in Salt Lake City, where I live. That's where if you buy that $700,000 bar, you're probably not storing that in your safe at home, because that's just, your safe doesn't allow enough protection for that. So what do? You go to Brinks, you deposit in their box, they give you a little receipt, and then you have physical gold. So we're all sitting around the table at this cruise with all these students at this investing conference, and I'm the paper assets guy, and I got Anthem, his wife is just delightful, and we're friends, so I can tell this story. And we're all sitting around talking about this, and I'm the only paper asset guy in the whole panel, so I'm getting beat up on a little bit, and I'm laughing. And real estate's real, and stocks aren't real; they're just paper. So Anthem is telling these guys, he's pitching gold, and I says, "Hey, Anthem, so how much gold should I really get?" And he says, "As much as you could." And I go, "Well, what if I just somehow could earn $100,000 and buy that much gold?" He says, "Oh, that'd be awesome. That'd be the smartest thing you do." I go, "Well, I don't feel good about keeping that in my house." And he goes, and he totally took the bait. And he goes, "Oh, no. We'll store it for you." I go, "Was there a fee for that?" And he goes, "Oh, it's tiny. I go, but I go, "How do I know it's mine?" And he goes, "Oh, I'll give you a little, you get a receipt and a little thing that says it's there." I go, "Hey, what do you print that on?" Excuse me. And the moment I said that, he knew he'd been had, and the whole table laughed. It was just a good joke. This GLD, you can't turn it in for gold. It's not like an old silver certificate where it's redeemable to the bearer on demand. That is true. But once and for all, Corey, is this backed by gold? Is it or is it not?
It is. It is backed by gold. Yep.
When you put money into this, they have to take that money and actually buy gold that they have it. The ETF has it. You just don't. Is that close? Is that close enough?
Yeah, exactly. So they actually have the gold stored in a vault. So this GLD is basically backed by physical gold, and you just become a shareholder. And essentially, if I'm buying into GLD, then I'm taking over for somebody that's selling on that side of it. And if there were enough buyers and so forth, they could go out and acquire more gold or whatever. But they pretty much have it backed by gold and don't have to do much in that way. It's just you're participating in the gold markets just like everyone else. What they don't like about it is that you only have a certificate, a paper,
right,
that basically says you have the rights to the gold,
and
you can't touch it. You don't have it in your hands. Well, they probably don't like that too much. But instead of storing it and paying a fee, what you're going to notice is, because we leave it in this format, we can actually cash flow it. We could go out and generate income where everyone else just sits around and stares at their gold and likes how shiny it is. We can actually generate cash flow off of gold.
Yes.
That we own, or make a promise to buy it if it goes to lower prices and get paid to do that. And there's all sorts of strategy around it that you can cash flow.
So it's not redeemable for gold like a silver certificate, but it is redeemable for cash like a stock. And if it follows gold, you'll get the cash equivalent in theory anyway. So how many of you guys have kind of been maybe rewinding, the orientation maybe? I gave an orientation Sunday night, and you saw me buying stuff with options, and you might still not understand those yet, but some of you guys see that? Yes, a little yes in there. And so we're starting to learn as a crew. You're starting to learn, as a team and as a group and as a family. Thank you, Roger. This is a great presentation. Thanks, Roger Weaver. What we're doing is we're actually going to use our stock investing skills on gold through an ETF that acts like a stock. So what's cool is thank you, Marianne says, I'm kicking myself for not getting this months ago. Thank you. And so right here, we're actually going to use our stock investing skills, and we're not investing. I should say trading. So all that stuff I was showing you with Coke and AT&T and all those stocks, that was investing the other night, and it's different. This is not investing. This is not gold bullion. This is for cash flow. So the way to get cash flow, one way we were getting cash flow the other night is here we have Corey, and here we have Andy, and I did this backwards. Look at that, Corey. This is the first time I've not been taller than you.
Much taller.
How does that feel?
Taller than you. Yeah.
And so Corey,
I must be standing on a ladder to get up above you.
So here I have some gold stock, and I'm a little bit afraid of this volatility. And maybe what my balance sheet looks like, I'm speculating here, maybe what I've done is I've got small amounts of cash, I have small amounts of income, but lots of GLD, and I think, okay, well, coronavirus, I'm okay now for a little while, but if I have to start liquidating this, I can't stomach my GLD falling lower than a certain price. I might say, look, I need this. I can't have this as a long-term investment. I can't hold this forever. I might have to liquidate my GLD. And you'll notice it's sitting, $1,700 an ounce. This is usually about $150 lower, and then a factor of 10. So if you take $1,700 an ounce and divide by 10, you get 170. Subtract $150. That's about where this is. Is that close, Corey, to say? Oh,
that's perfect.
Okay, so Corey, you are looking at this and you say, gold's pretty popular right now. You might look down here and notice that we're going to do more what, everyone? Technical analysis. We talked about the top of gold kind of hitting the top, but Corey, right here, I see something really interesting in my technicals. I see support there, support there, support there. To me, that 135 looks like a little bit of support. Right here, that 145 looks like a little support. Does that mean anything to you at all? You got any comments on that, bud?
Exactly right. So those might be some areas where you're looking to acquire gold or be a buyer of gold at those support levels. So if you're looking to buy the dip, you're looking back to where the price might be supported. Where is it likely to bounce from? Where are there likely to be buyers accumulating? And I may want to be a buyer. I might want to pick up some shares down there.
So I say, I want to be able, I'm not going to commit, but I like the choice. I want to be able to sell my GLD to someone else. And Corey says, I'll make a promise. I'll make a promise to buy it. Right? Promise to buy GLD. What you're going to make a promise and get an option here. I know there's going to be two parts to this, Corey, but let's talk about the short option first. What did you have in mind?
Yeah, so if I make a promise to buy, we could look at selling a put, which is a promise to buy. So what we're saying is I'm willing to pick up the shares down there, and we could look at, I think we can go all the way down there to about that 136 level, just above 135, and make a promise that would require us to pick up GLD at a steep discount. Notice it's all the way up here in the 150s right now, and I wouldn't have to buy it up there. I can make a promise that if it comes down here, I want to be a buyer. I want to be a buyer down here on the support and at this great level.
So pay attention, everyone, and please focus. And I love all your questions. Someone says one person once told me there's no bad questions. Yes, there are. Like, how's the weather up there? Or you're so tall, or your parents tall? Those are pretty bad questions. So keep your questions to help Corey, and we can't answer them all. Do your best to say, ask questions about this. Now, watch. How many can see right now there's a small picture and a big picture? Let's go big picture. How many can see us going back and forth through using the four pillars over and over and over again? Technical analysis, fundamental analysis, cash flow. Who can see us using the four pillars? That's the bigger picture today. So you start to realize, I hang out with these guys long enough. I'm going to start seeing this right here, right? I love that, Emmert. Nice, Emmert Follett or Follet. Okay, so can everyone see Corey's logic? It's like fundamentally, I wouldn't mind some gold exposure, right? Technically, I think this seems to be the next place where it bounces a lot. So I'll go 136. Now, what type of premium, and now we're talking about cash flow. So I'm not, Corey's not going to make this promise for free. Corey's going to demand that I send him a premium.
A premium.
What would you like to get out of something like this? Should we go look, or do you have something in mind? We can go look, or which one do you want?
Let's go take a look. And
all right, let me take a picture of this then. If I have to move, just give me a second, because we don't want to lose our little agreement here, right? We just barely got this thing. We might have this inked here in a minute. Let's see. File, open the clipboard.
And down there at 136, it's going to pay us in the neighborhood of about 50 cents or $50 per contract, it looks like, in that area.
Let me bring it up here. So we're going to go to our Analyze tab and look at a simulated trade. What month you want to do this for, Corey?
Go April, so we can keep it fairly short term here.
You want to go?
Yeah, I was looking at the 17th, so is that April 17th? The monthly options.
Oh, whoops! I've got this on single. Let me go single. Hang on. And option chain. I am not. I'm seeing April 20th. I'm not. This is kind of interesting what we've got here, Corey.
Yeah. So
how many days you want? I think they've got maybe
it's 24 days. So click that one right there.
That'll work.
There you go.
Okay. So for some reason, I've got spread in here. I just want a single spread.
Oh, we're on GC. Try go GLD.
That's
maybe
why.
that.
Sorry, my bad. I wasn't even in the wrong asset. Okay, so you want to go April 17th or 9th?
So 17th.
Now we're good.
That's the third Friday of the month,
Let's go
and
single.
that'll be towards the end of this Quick Start Lab. So we'll have a little paper trade here. Example.
Now let me bring in this here. So right now, we can see that it's around 153, so right around in this area. And Corey said we could go all this is, Corey, are you serious? When's the last time?
All the way down there to support.
Wait a minute. I just want to tell you, how many years you been trading?
About 20 years, yeah.
How many times have you been able to look at a precious metals? Look at that. I can barely fit it on the screen. When I said conservative, I didn't mean like, oh my gosh, Corey. I've never seen. Holy cow.
What's interesting about this, there's still premium out there all the way down there.
Okay, now
it speaks to the amount of volatility in the markets. The fact that asset prices are moving more means that people will pay more for insurance and people will collect more for insurance, because we're now living in a more volatile world, right? So asset prices are moving more, so you can go further out. And that's what we're doing. We're saying we're going clear. Okay. This is called out of the money, is what they call it.
I'm going to give you some language to learn. So these are called strike prices. So this is where it is today at 153. So watch this. 1 strike, 2 strikes, 3 strikes, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17. Did you ever in your wildest imagination, Corey, think that you and I would be teaching a class on GLD where I said, yeah, let's write a put 18 strikes out of the money with less than a month to go? Would you ever believe that? So I need to have you guys as students catch this right here. Okay, yeah, someone says, is this puts on the right and calls on the left? That is correct. So watch this. Do you guys understand that what you're learning today is going to work as far as the trade, but these are different times, and we're probably not going to have this rich of an opportunity later on. You guys understand that we're in perilous times? There's no parallel here.
But to put it into perspective, if this were a month ago, 2 months ago,
maybe 2 strikes,
that same option way down there wouldn't have any value. Essentially, people wouldn't be willing to pay anything for it because they'd say, well, there's no way the asset can go that far.
Yeah.
But because there is the potential that assets can move a long ways, there's actually a lot of premium in those still. And in this case, if you look at the bid-ask spread, that means buyers are at 43 cents and sellers are at 64 cents. We're basically in a situation where that still has 50 cents of value if we go in the middle there. That still has some real premium to it that normally wouldn't be there, to Andy's point. That wouldn't be trading for anything.
And we might not get, I think it's a little harder to shave or to split the spread when it's this far, but we try for that. We might have to back off and try for 52 cents or 50 or whatever. Is that true, Corey? It's sometimes a little tougher to shave that spread there, but that's where I would start. That'd be my starting point for sure.
Yeah, and we usually try to get, that's the mark or the midpoint. Think of it this way. If the buyer is at 43 and the seller is at 64, what's fair value? Well, fair value is probably in the middle. It's like an auction, right? Yeah. So you have buyers on this side, sellers on this side. They tend to meet in the middle. So if we put an order out there at the middle price, we'll probably get filled, but we might have to nudge it a little bit one way or the other. But 53 cents, that's $53 for a requirement to buy down there at, much, much lower price. And put this into perspective. Think of it this way. If the stock is at 153 and we're required to buy down at 136, we're 17 points out of the money. We have a padding, basically. We're 11% out of the money. In other words, as long as the stock doesn't go down by more than 11%, we're going to make money by taking that risk, by being the insurance company and providing that insurance.
Absolutely true.
We've got a lot of padding.
I gotta quit answering questions because someone's just asked me about a silver certificate and I answered the wrong question. I'm gonna leave that to you guys. So watch. So basically, Corey, I say I want to be able to sell my GLD at 135. I got to get those numbers even up.
Oh,
we're at 134.
136. 136 on both of them.
Okay, thank you, Corey. That's why you're here, is to keep me straight. 136 is what we're going to have. And I say, look, I'm scared. I can stomach a little loss here, but if this goes below 136, I got to liquidate. I can't, look, I might need this money. I might need this. And, I've got it now at 155, but if it loses more than 20 bucks, I can't stomach that. I got to have at least 136 bucks I can get out of this. So I get to sleep at night a lot better knowing that perhaps there's not going to be another earthquake this week in Salt Lake City like we had last week. And I sleep a lot better saying, look, even if I wake up and the market goes crazy and everyone loves this new cryptocurrency that the government's talking about putting out, and gold's going to go to tank, well, guess what? I know that at least Corey has promised me that he'll give me $136. So even if it goes to crap, at least I have a private agreement now that at least I know there's someone out there that has made me a commitment, a promise, that he'll sell it to me at. And I'm willing to pay that 53 cents. So basically, what is Corey selling, everyone? In fact, I'll let you guys say. Corey is really selling me a kind of what? Before I write it out here, I kind of let you cheat. I gave you the first two letters. Yeah, he's giving me some insurance. He's an insurance salesman right now. Except the only difference is he wouldn't mind keeping that promise possibly. Now.
Yeah, and here's the thing about we're dealing with put options. This is the reason that puts were created in the first place. The options market was created so that people would have a way to hedge and protect. So Andy is the hedge buyer.
Yep.
He's the buyer of the put. So in your notes, you write, okay, the buyer of the put, he gets something for the insurance he's buying, right? He has to pay a premium. Just like if you buy car insurance, you have to pay them money, but you get something for that. And what he gets is basically insurance in case gold were to collapse. If gold were to collapse in price, the ability for Andy to still be able to sell at 136 is very good. If the asset has fallen to 100, he still gets to sell it and get 136 out of it. Just the same way that if your car gets damaged, Say you buy a new car for 20 grand and it's totaled. It's worth zero. You still get to go to the insurance company and say, hey, you got to pay me the value of the car. That was our agreement, right? And that's what Andy's buying here. He's buying catastrophic insurance. In case GLD were to collapse, he's the buyer of the put. He has the ability to sell GLD for 136 if it were to collapse below that. On the other side of that, I'm the insurance company collecting premium but taking on a promise. So I actually have the greater risk. I'm the one that has the big risk here because Andy, he can only lose his premium, what he paid for the put. I can lose everything it falls below 136. I have that risk of the asset collapsing, but for taking on that risk, I'm the one that collects the premium.
Now, we're doing this at 136, and this is where we get complex. Now, in like 1 second, we're going to make this twice as confusing as it was before. So before we make this twice as confusing, let's just take a poll by everybody and say, if you're doing all right, say so far so good. Because we've talked about this trade a lot together, both in our first meeting together, also in our orientation together. So far so good. Now, I love Emmert. It's going to be repetition. You're halfway there. I love it. Okay, it's going to be a repetition. So far so good. The prior recordings help. Thanks, Gene Allen. The advanced course on this is called Ultimate Options, where we do a million trades like this. And this is probably why I put you here first, because this will be a stepping stone towards that Ultimate Options course someday. So watch this. If Corey wants in his asset column, Corey, if you want to do this, how much money are you going to have to do 100 shares?
Yeah, so that would be $13,600 is what I'm committing to.
Well,
it's 100.
Yeah, because it's 100. Well, 100 is you just put 2 zeros on it, right? 13,600.
So 136 times 100 shares, because I'm committing to buy 100 shares of stock at 136 per share. So if every share costs 136 times 100, add the 2 zeros, it's $13,600.
And how much am I? And the reason I have to have that is because in theory, if gold went to zero, I'd still have to buy it at 136. So I got to have all that money in theory. Okay, I got a problem, Corey. What if I've done a lot of trades like this for these guys so far to this point. We did this on Coke. We did this on ExxonMobil. We did it on Delta. We did it on. We've done it on several trades so far.
Yep.
What if I just paid to get in this class? I don't have that kind of money, but I want to learn quickly on my paper trades, and I want to learn how to paper trade less than that. You got any way that I could get some cash? Because I'm going to get $53 in cash flow. Is there another way you could do this that would help me? Maybe get a little bit more cash flow, or not have to have any tricks for me here? Anything you
absolutely. So what if we take some of that money that we would receive, that $53, and what if we said, well, I'm going to buy my own protection? So what
wait. So you're telling me I get this $53 now. So Corey now has the $53 in his pocket. So you just got that, right?
Yep.
Okay, what are you going to do now with that $53 I just gave you?
Basically, we can take some of that money and buy our own protective position. So if we're making a promise to buy at 136, what if we went down to a lower level and bought our own reinsurance policy, where we said, you know what, I'm not willing to take all of the risk. I'm not willing to lose if GLD goes completely down. Now, is gold going to go to zero? No, but I'm not willing to take the huge risk in case gold implodes, in case gold goes down dramatically for some odd reason. So I can take some of that money and buy my own reinsurance policy at a lower strike price, and that's called a spread trade. So where I'm spreading out my risk.
So what you're saying is you say, look, Corey says I make a promise to buy gold at 136, and I have the choice to sell this gold to him at 136, and I paid him $53. So now he comes back to the market with that $53, and you say, all right, I want the choice. Corey says, I now want the choice that since I promised to buy at 136, I want the choice to be able to sell at what price you want, Corey.
Yeah, and maybe you could do it where you just basically get your own kind of catastrophic insurance. Maybe you go to the 132 or the 131 or something like that, where you're just saying, okay, I'm willing to take some degree of risk, but I'm really not willing to take unlimited risk. Cool. And maybe even more important, what Andy said, maybe I just don't want to have all this capital tied up, and maybe I don't want to have that big risk profile, so I'm just going to cut those things off. And so I might look down there at the 132 and say, I'll buy my own protective position.
Corey, I'm sorry to laugh. When's the last time you taught a class where you had to scroll the option chain to find your strikes? That's why I'm laughing. So what do you want? 132, 131? What do you want?
Yeah, let's go to 131 because I think it's simpler math. That makes it a $5 spread. Okay. So let's do that.
So watch this. So we're promising 136, okay? And we say, Corey says, all right, I'll promise to buy at 136, but I can't stomach it going below what color should I use?
131.
131. So let's see what you get right here. If Joe comes to the table and he says, and let's see, Corey, for this 131 option, let's circle this so they can see it. For this 131 strike option, you're going to pay how much right here?
About 32 cents per contract, or $32.
Okay. Where are you going to come up with 32 cents? Oh, wait, everybody. Tell me, everyone, how is Corey going to come up with 32 cents to send to Joe? Where is Corey going to get the money, this 32 cents, to send to Joe? Where is he going to get it? From the 53? Now, wait a minute. I said I was going to make this twice as complicated. You guys aren't supposed to understand this that well. So he's going to use the money from the promise he made to buy insurance, to spend his money for me to buy insurance, to buy insurance from Joe Blow. So now Joe Blow over here is going to say, I promise Corey, right? I promise to buy, just like up here, I promise to buy the GLD at 131. Now, here is the interesting thing. And this is, if you get this, you're 90% of the way there. If you get this, you're 90% of the way there. If Corey's promising to buy at 136, but he's able to get rid of it at 131, what is Corey's maximum risk right here? You guys are beautiful. The difference. That's exactly right. What is 136 minus 131? If you buy, right, at 136 and you sell at 131, right? If you sell, let me get that a little clear here. If you buy at 136 and you sell at 131, you'd have a loss of what? $5. So even if this goes to zero, even if gold is now worthless and we raid Fort Knox and we start throwing it out of the sky like candy, the most he can lose is $5 times how many contracts, everybody? Or times how many shares, everybody? So if he's going to lose $5 on 100 shares, what's his max risk now? What's his max risk? Someone just said, you rock, Andy and Corey. Thank you. Okay, $500. Now, watch this. So if $500 is the most you could lose in this trade, even if gold goes to zero, if $500 is the most you could lose in this trade, how much money do you think the brokerage would require in your brokerage account to do this trade. If $500 is the most you could possibly lose, then how much do you think they'd need? Oh, I like the way you guys think. So maybe I've been watching Andy over the past few days saying, oh my gosh, Andy spent $27,000, on his ExxonMobil trade. Well, I don't have $27,000. But watch this math. So here we have, how much money, Corey, is this going to risk?
Going to risk $500.
Yeah, it's actually a little less than that, isn't it? But let's just go with that.
We'll get to that.
We'll get to that. Income expenses. So wait a minute. So if you received 53, but you only spent 32, how much does Corey have left in his account right there? What's it going to be, Corey?
21. Yep, 21 bucks.
So if you got 53 here and you spent 32 here, that means your income from this trade is $21, correct? Dollars, not cents, dollars. How many like the idea of making $21 off a $500 cover? Do you like that idea? $21.
Do you like a 4.2%
now
return?
Wait for the wait. Yeah. You stole it from me, man. You stole it from me. Now watch this. Folks, how many days is this for? How many days is this for? James Loonley says 1 month, 24 days. So we'll just call it, I think Ian Barnes, Ian Barnes, are you smoking something? Are you smoking something, Ian? Talk to me. What are you smoking? What are you drinking? I'm waiting for your response, Ian. What are you smoking? Oh, he's just laughing at me. Ian's laughing at me. Okay. I saw your answer. I'm like, you're smoking that Colorado grade marijuana, right? This is for a month, basically. It's a little less than a month, but can we call it a month? So watch this. $21 divided by $500 is, everyone? Corey gave it away. 4.2%.
I blew it.
For the 4.2%. Now wait a minute. Now Mo Evans is doing a little bit. Oh, Ken, you guys want me to annualize this, Ken? Some of you guys are getting ahead of me and doing the math. Look at this. Okay, here we go. What should I time? If I want to annualize that, what is the annualized return? Someone says 4.2 times 12. Okay, so I times this by 12. Are you out of your mind? Are you out of your mind? Oh, this is just how many want to quit? And we'll just close down the Cash Flow Academy and said we did our job. Or how many of you are going to take every class, every Quick Start Lab, everything? Who's taking it all? Now, this is what my goal was, and I usually don't share my goals, but here's the thing. When someone enrolls at the Cash Flow Academy, my goal is for them to look at this training compared to anything else they learned in school and say, this ranks where compared to this is the first class for many of you, and you had your 4 pillars. But where does this 4 pillars and this Quick Start Lab rank in terms of your law school, in terms of your MBA school, or where? Where are you going to put this in here? Because, I know that law school is like, I don't know how much it is because I can't pass a LSAT or an MCAT or any of that stuff. I'm too dumb. I love this. I love these comments. You guys are so good to me. I'm fishing for compliments. I'll admit it. I was fishing for them right there. Okay, this is fantastic. Okay, so that's the trade. Now, this is the name of that trade. So we're going to work on our nomenclature a little bit. Okay, what direction? Let's look at our risk graph right here. Well, first of all, let's do this trade, shall we? Let's put this trade in the risk graph, and then we'll be done. Okay, then we'll be done for the night. We go to our Analyze tab, and I'll build this in 2 trades, okay, instead of doing a vert. Is that all right, Corey, if I just do it in 2? You okay with that?
But when they do it, they would want to do it as a spread. Because,
yes.
Yeah, exactly.
You want to do it, and this is what's crazy, is people say, well, to do this one, I got to have 13 grand. Then go, nope. If you do these simultaneously at the same time, all you need is the $500 because they know it. The brokerage knows it. So you don't have to. Yeah.
And importantly, you can specify exactly how much you want to get for this spread.
Yes, you can.
So we're talking about 21 cents. Well, you could put your order out and you could say, I only want to do this if I can get 25 cents credit.
Or don't take it. Yeah.
Or don't do anything. And you won't get filled on one leg and not the other if you do it as what they call a spread trade. So you'd say, I want to sell this put, buy this put, and I want at least this much credit. And we'll kind of show you how that works.
Okay, so I'm going to have to adjust these a little bit. Well, you know what? Let's just teach them to do it the right way. I like it I like it this way first, Corey, so they can kind of see, and then we'll do it both.
Do it one by one and then do it together.
On this one, if we go in between, like Corey said, if they're asking 64 and bidding 43, the middle of that is 54 cents. So let's go for 54 on what we want to collect. So we'll go up here and say 54 cents that we collect. Well, we'll just go 53 because that's what we did in our example, 53 cents. Okay, now we're going to go up here and it's 24 and 38. So we don't want to pay 38. We'd rather pay close to the 24. So it's 32. So we're going to take this down to 32. So now I have what's called the mark or the midpoint, or the, you have the natural and the midpoint. And I use in this 53 and this 32 because I don't want to pay full price and I don't want to sell for the low price. Everybody understand that? Give me a yes. Okay, very simple, really easy. Okay, we're going to click this, and this is my risk profile. Now, this puts this in perspective because this actually isn't out of the realm of reality here. I'm going to go to set my slices to break even on this one, Corey, at 418. There's an 86% chance, and I'll just circle this on the risk graph so you can correlate it. By the way, we've done fundamental analysis, technical analysis, cash flow. What kind of graph is this? Risk assessment. So I'm going to circle this right here, and the blue line tells me how much money we get at expiration. So we're going to get that $21, just like we said at expiration. Now, someone says, well, Andy, I have more than $500. Okay, great. How much do you have? Oh, I got $5,000. Oh, you do? Okay, well, then maybe you do 10 contracts, right? Maybe you do 10. And so now you get $210 off 5,000. Same thing, right? Same thing. So let's put that back down to one contract just for beginners, right? In your paper trade account, okay, one. Got to buy and sell the stuff. I can get it down to one. Whoop, there we go. That looks right, Corey, $21. And I have an 86% chance that I'm just going to make this $21, but I've got a 13% chance it might go there. So is that a legitimate thing? That is, right, Corey? That's legit, isn't it? We got to worry about that.
Yep, exactly.
So if this starts climbing up here, this is why I'm going to have everyone doing this a paper trade account, because you haven't learned how to deal with this yet. But in reality, could you actually just say, you know what, I really would buy some of that. You could erase that, but then you'd have to have money to buy it. So we've got to manage this risk right here. And that is the mother of this thing. That's what's tough on this thing, is managing that risk. So that's where we delta hedge, we take half off the table. There's a lot of things. You want to talk about the risk management on this, Corey?
Yeah, I mean,
because we're making principle.
Yeah, think of it as if they're giving you a 4% return on your money, they're not doing that for zero reason, right? We're acting as the insurance company. So in this capacity, we're acting as Corey in the example. I'm making a promise to buy at 136. So if it starts to go down and put me in danger, I may have to act as a risk manager and say, okay, what's my assessment for this? And there are some things that we can do to protect this position. We can do some things that basically counteract the movement. So as the stock goes down, we could put on our own hedge that goes up in value as the stock goes down to kind of offset risk and do some things that way.
Right.
If we don't do anything and this completely tanks, it's not probable that will happen, but if it does, then we do have risk that's greater than reward. You'll notice we can only make the $21. Well, we have greater risk than that of $479 in the spread, right?
Yeah.
That's our risk to reward ratio.
How many shares of this could I actually, well, let me give the name of this first. So right here, we have to have a name for this trade. And I'm going to show you how we name this trade. You don't need to know this tonight because it'll come. And as you take, like, I don't want to be Mr. Salesman here. I did not sell this hard before. I won't sell it hard here because you're ways out from it. But Corey and I have a class that is 1 year long. If you took one class a week, it'd take you about a year to get through it. Who's interested in that? I'm just curious. I'm not going to offer it tonight, but I'm just interested to see who'd be interested in hanging out with us once a week for a year. Okay, so this is like scratching the surface of what we can do and teach you, okay? But we got to start preparing you for that course right now, because remember how I said I don't let anyone in this one unless they're in the 4 pillars? I really don't like anyone in the ultimate options until they've completed this one, right? So they build on each other. So we got to learn some names here to not only let you know how to do this one, but for those of you who want to learn even more, this is a foundation. So what direction do we want the stock to go starting tomorrow? Up, down, up, or down? Which way would we want the stock to go? What do you think? Let's scroll down to your answers here. Yep, you guys got it. Up. Yeah, I absolutely want it to go up. So the bulls go down, the bears go down, but the bulls go up. So the first word we want to use to describe this trade is the direction we want the stock to go, which is bullish. This is a bullish trade. We're bullish on gold. Fundamentally, technically, we saw the whole thing. We're bullish. Okay, are we using puts or calls here? Which one? Are we using puts or calls here? We're using puts. So I'm going to put bull put. Now, are we paying? Now, this is what really bakes people's noodle. This is hard for people to understand. Are we paying money when we make this trade, or are we actually receiving $21? When we click the button here and we sell these two at the same time, is this going to be a credit or a debit? In fact, let's do that as one right here. We're going to go into analyze, and I can't even find all my stuff here. I want to go into a vertical spread, and I want to do, let's just sell this one right here. Let's just sell a vertical, analyze, sell, trade, vertical. And we said what, Corey? We were going to do 131.
136 is what we're selling, and 131 strike is what we're buying.
Okay, 136 is what we're selling.
Oh, so that one put on 131. I think you're on the buy right there. Yep, flip those around.
Excuse me. Okay, I got me on the buy. I want 131 on the buy, and I want 136 on the sell. Okay, right there. And it's got 21 cents in the middle automatic. So it split the spread automatically for me. So there's my trade. Now watch this. If I confirm and send this, okay, and Corey, would you mind putting this trade in the other account so I don't have to mess with this one? Because I've actually got some, if you notice, I already have 200 shares of gold in the paper trade account here, and I unchecked it so we couldn't see it. I've already got some of this, is what I'm saying. I want to commingle it. So right here, notice this. Once I hit this send button, I'm going to get a credit of $21 minus a trading fee for 19 bucks. Okay? If I were to do 10 of these, it'd be $210. If I did 100 of these, it'd be $2,000, right? My break even is 135. So am I having money go out of my account, debited out, or am I actually, when I click this button, I just received $21? Is that crazy? Because most people, when you buy stock, you see money go out and stock come in. Right here, we click this button, we just got $21 richer. Immediately, the money goes right there. So I'm gonna close that. So we have bull put. The next word is credit. And we're spreading between these two prices, right? We're spreading out the risk between 136, spread. So the long formal name of this trade, bull put credit spread. Bull put credit spread. Now, What we're going to have to watch over the next week is if you do you do this in a real account or a paper trade account if you follow along with this trade? Real or paper at first? What do? Everyone's doing paper. Look, coronavirus isn't going to go anywhere that quick. I love you guys. Paper, everybody. And what we're going to do is we're going to watch it and see where it goes on Thursday, and we're going to talk about the risk management of this trade on Thursday after we see where it goes in real life. And so that's why it's so important to do. Now, don't just go with these numbers. We're going to see where this winds up in 2 days, and then we're going to look at the most important pillar, and we're going to spend some time on risk management of this next week, okay, when we meet together. Okay, great. A little bit longer class. I wanted to go 90 minutes, 2 hours, but I love you guys anyway. Awesome. I'm glad, Emmert. I'm glad. So let's see how we're doing so far. This is called a bull put credit spread. Some people call it a put spread or credit spread for short, but that's the formal name, bull put credit spread. How are we doing as your teachers, Corey and I? Give us a grade or a 1 to 10, 10 being awesome, 1 you guys totally suck. Okay, Andy sucks, 10, Corey's awesome. No, I'm kidding. This is fantastic. You know what? We're getting some A pluses and some 10s, and you guys are freaking out. Well, that's what we wanted to hear. Look, here's the order of the letters you're going to send me. The first letter you send me, because these give me dopamine hits when I get these letters. It makes the hard work we do, because you got to realize putting all this stuff together, big hand for my partner Mike and our whole team. These classes, the technology is not easy to do. We got a whole team of people doing this behind the scenes. And so the first letter that make me feel good is something like, hey, Andy, 4 days ago, I didn't even know about stock trading. Just tell me your sentiments, right? Give me that. Or my favorite letter to get is, Andy, you may be a moron in every other area of your life. You don't even remember where you parked your car. You don't even remember where your car keys are, but somehow you and Corey, you make this stuff a little more simple than I thought it'd be. That's the letter I want. Those are the ones I frame in the office.
Andy, how cool was this comment? Mark says, I have my 14-year-old son learning this with me, and he said, you guys rock.
Don't do that.
That's cool.
Don't do that to me, man. My son's 14, okay? I'm already an emotional mess this week, okay? We had an earthquake. I'm all messed up.
That's awesome.
But that's the one I want. And then the next one that I get is like, a little ways from now, you say, hey, Andy, I've been paper trading. I've had wins and losses. I'm starting to understand the wins and the losses. And then, later on, maybe you send me a little letter, say, hey, I made a little money. I never publish those because those are between you and I. I really like the ones where people say you made it simple. So if you got a chance to, send an email or something we can use in our marketing, let me ask you this. Would this be worth telling a friend about, in the next week? If you know someone that would benefit from this information, hey, maybe you send them our way. I have employees like everybody else, and I think Corey and I probably will be okay through this. I hope. You never say never. Maybe I'll be calling you guys and see if I can sleep on your basement mattress. But I do have employees, and it's important that I keep them going. So if you would mind sharing the word, if you like these classes, if you wouldn't mind sharing the word, maybe say, you know what? Send them over to the Cashflow Academy and say, hey, these guys will take care of me. Last thing, some of you have been asking, I didn't want to go here. Some of you guys have been asked about the coaching program. All I can say is get on the list, okay? We have a support. You go to that on the website. We did that in the orientation. Go to support. Try to get on the list for coaching, and we just do that first come, first serve. Thank you so much. 2-hour class tonight. Freaking 30 minutes longer. Sorry, Corey.
So much fun.
Sorry,
much fun.
Man.
I loved it.
Corey is the man. It's fun having an options principal to teach this with you, especially when the reason I have Corey is most options principals were born without a personality. So it's nice to have Corey here. Okay.
That might be also true for me as well. So I just try to keep up. I'm about half the man Andy is in both size and ability and everything else.
No, it's a big deal. All right. Good night, everyone. This will be recorded, or it was recorded. Hopefully, I see the recording button on, so hopefully it's recorded. We'll upload this so you can rewatch it as session one of 8 this month. We're going to do 2 a week for a month during this crisis live, And we do them once a year. It just happened to fall on this, just out of sheer unadulterated freaking coincidence. We were even thinking about not doing them and just suspending them. And under the circumstances, I think we made the right decision to do this. So look forward to Thursday. You're in the right place, you're in the right time. We're going to do everything we can for you. You guys were great students. Can't believe how well they did, Corey.
So great.
So we will see you guys on when are we doing Thursday?
Thursday morning. Thursday morning at noon Eastern. So 9 o'clock a.m. Pacific.
9 o'clock, yeah, Eastern. 9 o'clock
Better than
Pacific.
Netflix.
Better Netflix. And again, we record it. We want to be fair to the people that have night jobs that want to watch it in the day. So we'll alternate and move them around. Sometimes a different day, all that type of stuff. Good night, everybody. Great job.
Good night, everyone.